Hello, everybody. Welcome to CLEF Investments. Today, let's start with my overall investment principles. So I use one word, CLEF, to summarize it. The dictionary said this is something about music, but I don't know about that. This just looks like a big dollar sign to me. So let's first look at the first letter, C, conscious. So this means I always need to stay conscious to know my investment, why it creates value, why it can make certain amount of return for me, so that it avoid me to not become too greedy. For example, if somebody tells you that there's a crypto coin called Luna or Terra, and once you deposit your money into it, every year you get 20% return. And for doing nothing, why? If you don't know why, very likely it's a fraud, and indeed it is a fraud. Another example, you look at Bernie Madoff's scandal, the Ponzi scheme. His fund returned about 10 to 12% every year consistently. So basically, every month it makes 1%, and it continued for many decades. So this is too good to be true. So I'm not saying that you cannot make more money, but you have to understand why. And maybe you're taking a lot more risk, you don't know. Maybe there's something else behind it. So, but anyway, stay conscious to not get greedy. And you need to be aware of some common numbers. For example, the stock market in United States grew about 10% every year in the long term. And the inflation is about 3% a year, and so on. So these numbers are not a very big number. And if you see a very big return every year, you need to raise a warning sign and ask why. Okay, the next one is L, lazy. So as I said in the last video, I have a full-time job. So I don't want to spend too much time on investments. I want to spend a little bit of time to do the investment and then forget about it. If any investment strategy requires me to watch the market, look at the news, and so on for lots of time, it's not for me. It's not useful for my lifestyle. And the next one is economical. So basically, I want to reduce cost. I want to reduce all kinds of cost in investments, such as tax, management fee, slippage, or when you buy and sell stock, there's a bid-ask spread, or commission. Recently, there's some many stockbrokers no longer charge commission when you buy and sell stocks, but actually they let you pay some of the cost in the form of slippage. They fill your stock in some worse value so that you pay the cost of commission in a bigger amount, but it's not obvious to you. So all those costs are negative numbers on top of your return. And even if the number is small, you need to be cautious that whether it can become big. So for example, if you find a financial advisor which charge you 1% of your overall asset every year, then if you let this financial advisor manage your money for 40 years, it effectively takes away 40% of your overall asset. So if this financial advisor cannot provide a lot more value than 40% of the actual cost, then it's not worth considering. So the cost is a very important thing. If you do everything else equal and you have less cost, you have more money left. And given the law of the exponential growth, if you have more money left each year over time, you will have a lot of money, a lot of more money left. And finally, foolproof. So any investment principle or strategy I follow must have very easy to follow steps so that I don't need to second guess. It has clear rule, when to buy, how much to buy, when to sell, and so on. So if a rule said, if you think market gonna go up, you buy, and you think it's at the top, you sell. No, I cannot do that. I don't believe anybody can do that. So I can only follow very simple rules in my investment. Okay, that's all for today. See you next week.